Hello, everyone. My name is Logan Skillman, and welcome to the First Time Homebuyer Seminar here with CMG Home Loans. Got a lot of exciting information for you guys tonight, and really looking forward to sharing everything with you. So, just a little bit about me. My name is Logan Skillman. I'm a senior loan officer here at CMG Home Loans. I've been a loan officer for 9 years and here at CMG for the past five. And I am currently working on obtaining my MBA from Johns Hopkins Carey Business School. All right. So one of the first questions that I'm sure everybody's wondering right now is it a good time to become a homeowner? We've seen the markets are changing and things like that. So is now the best time to do it? And that's really the elephant in the room. So why should we do it right now? Why should you become a homeowner? Well, one, the market has shifted versus the past couple years. We're now in a buyer's market. And that means a lot of great things for you, like less competition for the homes that you like. You're able to negotiate with sellers. And most importantly, you're no longer going to be paying grossly over the market price of a home. So just a little bit of insight into what are we seeing in the market right now. For one, home prices are going down. We are seeing homes that previously were selling for a lot more. You know, Sellers are dropping the price because they know that they can't get absurdly inflated prices now. The average home price in Maryland for September was $373,264. Days on market has gone up. The average home is sitting on the market for 36 days currently. That's a huge advantage to you because no longer are homes being listed on Friday and being under contract and sold by Saturday morning. The list to sales price is going down month over month. Currently, it's sitting at 99.9%. Now, what does that mean? That means that as a home is listed, the sales price of the home is actually going below the list price, and we're seeing it continue to drop more and more. Now, what does this mean for you as a buyer? So first, you can secure a great price on a home purchase. You don't have as much competition in the market. You're not competing against 15 offers on every home. You might be the only offer on the home. And very importantly, sellers are more willing to work with buyers on doing repairs or offering concessions and things like that. And just as importantly, all contingencies are stay in place. No longer are you having to waive inspections and things like that just to get the seller to accept your offer. You're able to still protect yourself, have all your inspection contingencies and things like that in place so that if there is a problem, you're not stuck with it. And this means that you can potentially offer under the list price of a home. You can get the seller to contribute a credit towards buying down your rate or covering some of your closing costs. And also, you can take your time. You're not going to have to jump on a house the moment it hits the market and not do as much of your due diligence as you really wanted to. But at the same time, you don't want to wait too long and miss the market. So just a little brief visualization. Back in July of 2021, homes were listing at 300,000 but ended up being sold for 350,000. And yes, we had record low interest rates right then. So you'd be looking on a $350,000 purchase price at a loan amount of a 339,500 and a monthly payment of $1,430 versus in January 2022, that same house is selling under list price. The interest rate is slightly higher, but your down payment is $3,000 less. That's 3,000 extra dollars that you get to keep in your pocket every month. And your monthly payment is only about $100 different than it would have been in 2021. Now, another thing I like to address when we're talking about is now a good time, let's look at your future. If you're currently renting your home, for $2,500 a month. Annual rent increases average 6%. You're paying renter's insurance. Over the next 3 years, you'll spend $95,868 on your housing expense. That's money that you do not recoup. That's going to your landlord and your renter's insurance. Versus if you were to purchase a home for $300,000, you have a low down payment of 3%. In 3 years, you're actually going to see a gain in your equity and in your bank account of $47,696. It's a huge difference in total appreciation and your net worth. That's building your net worth for the future. Now, how do you know how much house you can afford? It's we all see homes on TV and on the internet, and we want to know, oh, could I afford this house? Well, the steps to determine that are really simple. There are three steps to the approvals, three types of approvals, really. There's a pre-qualification, a pre-approval, and a full approval. And just to discuss kind of what each one represents. A pre-qualification is no cost. It's a simple discussion that we would have over the phone, take about 5-10 minutes, kind of talk about your basic situation and what you're looking for, etc. We're not verifying anything, we're not running credit, anything like that, but it gives you an idea of what you could be qualified for. The only problem is because we're not verifying anything, there really is no confidence in these for a seller or for yourself because we haven't verified anything. Now, the next step is a pre-approval. Again, this is no cost. With a pre-approval, we will do a full application. We'll verify your credit, your income, and your assets. Someone like myself will do that. And then these are standard in most markets. They're nothing special. So it doesn't really help you stand out in any way to a seller. Then something we do here at CMG Home Loans that's kind of unique is we will fully underwrite your pre-approval up front. Again, this is at no cost. We'll take the full application. Your credit, income, and assets will be verified by one of our underwriters, and they will go through the entire underwriting process on your loan. This gives you and the seller of your property a huge confidence boost because they know and you know that your loan has already been underwritten and it's going to be able to close. Because we've already underwritten it and we know what additional items may be needed, we can actually accelerate your closing time to as little as 12 days. So you can help beat out other offers if there are them by offering a shorter time period. Now, one big question a lot of folks also ask is, how do I come up with a down payment? I showed you a big number there earlier, $9,000. How do we get to that figure? Now, while we're discussing this, I want to kind of introduce this concept. It's called the mortgage triangle. Your mortgage is comprised of three main items: your interest rate, the term or the length of your loan, and your loan amount, so the amount that you borrow. And as you can see here, those are the big items that comprise the total cost of your mortgage loan. Now, on the bottom here, we do see there are grant programs, down payment assistance options, and even down payment gifting to help you reduce the amount that you have to borrow. Because the bigger the down payment, the smaller the loan amount, the lower the cost of the mortgage. So, just to kind of discuss, what do you need for a down payment? What's the minimum? These are the three most common loan programs in most cases. So there's a conventional loan where we can do as little as 3% down, an FHA loan where we put as little as 3.5% down. And for our veterans, we offer VA loans where you have no down payment required. You do not have to come up with any extra down payment. Now, again, how do we get to this 3% or this 3.5% that we need? Well, We've got options to assist you with getting some of those funds. We have access to a Borrow Smart grant. This is a grant that's offered based on your qualifying income, and you can get up to $2,500 in down payment and closing cost assistance. There are state and local programs in most states where we're able to partner with them and they will offer you down payment assistance, sometimes as much as 4 or 5% of your total purchase price. Agent contributions. Most folks don't know that agents, your real estate agent is able to contribute a portion of their commission towards helping you cover your down payment and closing costs. We work with a number of agents around the country that offer this type of service. And then Home Funded. This is our proprietary crowdfunding program to make receiving gift towards your down payment easier. And I'll get into that in a little bit more detail here in a moment. So, Home Funded, you're able to crowdsource your down payment. So, what we will do is create a web page where you're telling your campaign story, kind of similar to like a GoFundMe or something like that. And it allows family, friends, coworkers, church associates, whoever it may be, to go online and deposit money as a gift to you to help you lower your down payment requirement. Now, with Home Funded, we also offer a service called Up It, where you can get extra pledges toward your down payment when you shop at over 1,000 participating online retailers through the Up It program. And with Home Funded, we offer a closing cost grant of up to $2,000 based on matching 2 to 1 for every dollar you receive through Home Funded. So if you receive $1,000 through Home Funded, we're going to give you an additional 2,000, and right there, you're at $3,000 towards your down payment goal. Now, another big question: how do I get the best mortgage? What is comprised of that? So again, we're going to be looking at our mortgage triangle here. We're going to look at different options, whether it be a 30, 20, or 15-year term, potentially buying down your interest rate, or maybe an adjustable rate mortgage. One beautiful thing about working with a company like ours that has a lot of options is that we can look at a customized mortgage plan for each individual. So, how to secure the lowest interest rate? Something we are all concerned about. We've heard about it for years. Interest rate, interest rate, interest rate. But a lot of people don't know that there are options regarding interest rate to change what you get. The first is a permanent buy down, where you buy down your interest rate for the life of the loan. The second is a temporary buy down, where you buy down your rate for the first 2 to 3 years of the loan. Now, one of the big things to do is to work with a lender with a plethora of options because different programs have different rates. And here at CMG, we do have a plethora of options that we will explore for you. Consider a shorter term fixed rate loan. Shorter loan terms do tend to have lower interest rates. And consider an adjustable rate mortgage because, again, adjustable rate mortgages tend to have low introductory rates that can help save you money. So I threw something at you there. A permanent buy down. How does that work? So imagine that today's rate is a 6.5%, and you're taking a loan for 300,000. Now your payment on that for principal and interest would be $1,896. Now, if you were to buy your rate down to $5.75, that would give you a monthly payment of 1,751. Now, let's assume that buy down cost is $5,000, but you're able to negotiate in this market and get your seller to give you a credit of $5,000. So they're paying for your buy down. That's resulting in a monthly savings of $145. And over the first 10 years of your loan, you will save $17,400 on your loan simply by having your seller contribute the buy down cost. Now, the other one, a temporary buy down. So, this again can be paid by your seller. The way this works is that for the first 3 years of the loan, we're going to reduce your interest rate. The first year, it'll be reduced, or I'm sorry, for the first 2 years of the loan, we'll be reducing your interest rate. The first year, it's reduced by 2%, giving you a monthly payment of 1,520. The second year, it's reduced by 1%. So your payment will be $1,703. And in the third year, we go back to your total interest rate and get you your $1,896. Now, just in those first 2 years, you're going to save this $6,828 because that is coming off your interest rate, and your seller can pay that through their contribution as well. So if you think rates are going to drop in 2 or 3 years and you want to get in the house now, but you don't want to pay that high rate, you can go ahead, do this temporary buy down program. And for the first 2 years or 3 years, even, because we do have an option to do 2 years or 3 years, your interest rate is lowered and you're paying a lower monthly payment. And if rates come down, you're able to refinance. And now, speaking of that, again, with why do we want to buy now? Well, yes, interest rates are higher, but they're not going to stay higher. They're going to come down. And here at CMG, we offer the Rate Rebound Program. Now, how does this work? If you purchase a home with us by, it's actually September now, we've extended the deadline by September 2023, you have up to 5 years after closing on that loan to refinance with us. And if you do, we will waive all of our fees. We will waive all of the appraisal fee, and we'll give you $1,000 credit to cover any third party charges that might be out there versus other companies that really don't do that. So it's a great opportunity if rates do come down to drop your interest rate at little to no cost to you. Now, I also mentioned to you adjustable rate mortgages. So here's just a little comparison for us looking at a 30-year fixed rate mortgage and an adjustable rate mortgage that's fixed rate for the first 10 years and then would become adjustable. So with adjustable rate mortgages having a low introductory rate of 5.25%, that $300,000 loan would result in a monthly payment of $1,657, which would be lowering your payment by almost $240 every month just by looking at that adjustable rate mortgage. And again, we have our rate rebound program. So if during that first 5 years you see rates come down and you want to get the security of a fixed rate loan, you can do that at little to no cost to you. Now, one other thing I like to talk to people about regarding reducing the cost of your loan, reducing the effects of your interest rate and everything like that is a biweekly loan plan. Now, this will help you pay your loan off faster and attack the principal balance of your loan faster, which will result in you paying less over the life of your loan. So, what is a biweekly payment plan? Again, we've got our $300,000 loan amount, but rather than making one monthly payment each month, what you're going to do instead is send a half payment every 2 weeks. So over the course of a year, you actually end up making 13 monthly payments. Each month, this would cost you in a total $146 extra. This will reduce your term to 24 years on a 30-year loan. So it's taken 6 years off the term. And by paying the loan off faster, you're seeing total interest savings, interest and term of $88,121. A lot of folks love using this type of plan if they get paid every 2 weeks because they'll just have it set up as an automatic deduction from their paycheck that goes directly to the payment, and they don't have to worry about making sure that they have the big payment at the end of every month. It's a really great option that gives us the ability to pay the loan off faster, especially if this is your forever home. Now, the next elephant in the room is, how do I qualify? Yeah, all these things have sounded great, but how do I know if I can do this, right? What are the requirements? Well, back to our standard loan programs, there's credit. Credit is one of the first things we're going to look at. For a conventional loan, you need at least a 620 credit score, an FHA loan, a 580, and for VA, we also only require a 580 as well. Now, income. So for conventional loan, we're going to look for a debt to income ratio of generally no more than 45%. For FHA, we're looking at a debt to income ratio of up to 56%. And for VA loans, it's 65%. Now, what is a debt to income ratio? Essentially, a debt to income ratio is the amount that you have going out towards your debts that are your car loans, your student loans, your credit cards, things that are reported on your credit, as well as the potential mortgage payment versus your income. So essentially, if you have $100 going in and 40 going out each month for those debts, your debt to income ratio is at 40%. And it's really a helpful tool for us because, and for you, because if your debt to income ratio is going to be 70 or 80%, you're not going to be able to, you're going to be struggling to get by every month. And if something happens, you could be in trouble because you wouldn't have the extra income to be able to save or to do anything else with. Now, what are our next steps? What's the next step of this process? All right, so the first next step is to get pre-approved and do a full approval. We do that by completing our conversation on the phone, taking the application, and determining what your qualifications are and what programs are going to work best for you. We'll then gather up some documentation from you regarding your assets, your income. We'll check the credit and send everything to our underwriter to review. Next, you get a customized home buying consultation. We'll help you set up with your realtors who are going to look at everything for you. They're going to help you find the best homes possible and work with us to make sure that we're building you the best loan to meet those needs. Your realtor set up that home search, and when they find properties for you, they're going to start taking you out and you get to view these new homes. You find the one you like and you write an offer on it. And once your offer is accepted, we open escrow and then we can close in 21, 30, or even 45 days. And you can become a homeowner and you can set yourself up in your own home and no longer be renting someone else's. And, oops, sorry, I hit the wrong button. Just one more time, folks, it's been a pleasure speaking with you here today. This is my contact information. Please feel free to schedule a consultation. My Calendly link there will take you in and it'll help you reserve a spot on my calendar where I will give you a call and we'll be happy to discuss what options are available to you and get the process started. Please feel free to send me an email or give me a call directly as well. I'm more than happy to speak with folks anytime. Thank you very much. I appreciate your time this evening.